If casinos around the world suddenly gained a similar edge as trading covered calls, they would literally be sued by every country or state in which they operated, because their edge would be so large that it would be illegal. But in the stock market, you can literally be that casino legally by trading covered calls. And in this video, I'm going to show you just how massive the edge can be and why I wish so badly that I had discovered this strategy sooner. And don't worry about the how, we'll cover that in future videos. Right now, I just want to show you just how powerful this stuff is. The best way I can describe just how lucrative covered calls are is imagine that you had to make money by doing the opposite of covered calls. Fast forward 2 weeks and let's say the stock goes up from $100 to $104. Your stock went up 4 whopping percent in 2 weeks, which by the way is a compounded annual rate of return of 167%. So surely you made at least some money, right? No. In fact, you lost money. In fact, you lost the entire value of your option because your break-even point wasn't until $105. If you're wondering who in the right mind would want to play that game, well, the answer is it's a lot of people. There's a lot of people out there willing to gamble for the off chance that they hit it really big. And there's a lot of traders and even institutions that are buying options as hedges or insurance policies on their positions. So as crazy as it seems, there's more than enough demand for options, and we're more than happy to sell them to whomever wants them. So how big is your edge trading covered calls exactly, and how much money can you expect to make? The best way I can describe the edge in trading covered calls is to draw a comparison to a game that many of you are familiar with, which is roulette. And just to be clear, I'm talking about the casino's edge here, because we all know that the players don't have any edge at all. So as you probably know, the roulette wheel has 2 spaces out of 35 that are neither red nor black. These 2 spaces, which are 0 and 00, give the house an inherent 6% edge, roughly. And to draw a comparison to covered calls, if you simply close your eyes and enter into covered calls positions every month without even looking at the price charts, that's roughly your edge. Because historically, options are priced about 6% above the fair value that the Black-Scholes equation would dictate. But with a couple basic trade filters that I'm going to teach you, you can actually bring that edge way higher. And during bull markets, it's not uncommon to see 10 to 20% months, especially if you trade the highest implied volatility stocks. And during bear markets, it's possible to actually break even or even make a small profit. Think of trading covered calls as operating a roulette wheel with double or triple the usual house edge. In this next video, I'm going to show you a simple 2-step system that your grandmother can follow to replace your income with covered calls. I'm going to lay out absolutely everything you need to know. No paywalls. I'm not going to tell you to buy some course for $4.99, which has the real secrets. Nothing like that. It's all there, and if I do leave something out, I'm going to give that information for free in a future video. I'll see you there.